Markets are down, the crypto bubble has burst, and Elon has fired half of Twitter. What does this mean for early stage startups? In today's video, I'm going to be talking about how macroeconomics and large-scale world events actually affect early-stage startups. Does our day-to-day look any different? Have our plans changed in any way? Make sure you stick around to the end of this video to find out how exactly all of these world events have affected my company, Clear. But before we get into specifics of my company, I'm going to talk about how I've seen some founders be affected by the current economic and global situation. Probably the biggest thing I've noticed is that less founders are raising capital at the moment, which makes sense. There's less capital being deployed, investors are having a lower risk appetite due to more economic uncertainty. For a lot of founders, if they can avoid fundraising, they are avoiding it entirely. Another reason for this is that valuations are much lower, which means as a founder, your dilution will be much higher to raise the same amount of capital that you might have done a year ago. For the founders that are fundraising, I've noticed that rounds tend to be smaller. Companies are raising less money than they were before. This has also caused some interesting shifts in dynamic between founders and investors. Founders know that not every VC fund is actively deploying capital, but a lot of funds are still taking meetings with founders. So for the founders, it can be quite disheartening talking to an investor with no real chance that they're going to invest in their round. Another big change I've noticed is a shift in focus within startups. A lot of founders have shifted their mentality away from exponential growth towards merely staying alive for as long as possible. What this looks like in terms of everyday actions is cost cuts. Most companies are drastically cutting their costs to increase their runway for 24 months or more, which is pretty long in the world of startups. One of the most effective ways to cut costs is to cut people, which is why you're seeing mass layoffs at a lot of different companies. Interestingly, for the few startups that are hiring, because of this imbalance in having more people looking for jobs than jobs around, the power has kind of shifted back into the employer's hand, where the talent pool is much bigger and there's that many more people looking for jobs, that hiring has actually become slightly easier and more favorable for startups. However, for a lot of people who are being laid off from their startups, we're actually seeing an increase in bootstrap startups, and this can be quite typical in times of recession, where people that end up leaving larger organizations finally feel like they have the chance to work on something of their own. So I have also seen an increase in the number of bootstrap startups, which is really exciting. It seems like the worst affected industries are industries where there was either a lot of hype previously or very capital intensive industries. And the last point is that investors are finally doing more due diligence on early stage companies. And in fact, it's not just investors. Customers are being more careful about where they want to spend their money. Partners don't have the budgets that they used to. Money is tighter for everyone. So it seems the bar for forming a partnership, whether that's through an investment relationship or a customer relationship, has gone higher, which isn't necessarily a bad thing. Now, these are some of the general trends I've spotted, but have these macroeconomic conditions affected my company? To be honest, not really. I do acknowledge that a big part of a company's success is timing and market conditions, and I was really lucky to have raised my funding round last year. Although fundraising was hard for me, as I've talked about in previous videos, I do think if I'd have been raising this time this year, it would have been even harder. I also haven't really needed to cut any costs because I've always held a more long-term view and had my priorities very clear from the beginning. Despite at times facing pressure from my investors to increase my burn rate and spend more money, because I have always very carefully managed our company finances, I didn't need to cut any costs, and in fact, we've been hiring during this economic downturn. My belief is that for early stage companies, the focus should always be product market fit. And with every decision you make, you need to ask, is this bringing me closer to product market fit? Or is it somehow distracting the team's efforts to getting there? And more often than not, if you can figure out how to finance the company so that you can afford the team that you need, the macroeconomic conditions shouldn't have that big of an impact on your day-to-day. But that's just my take and just how I like to run my company. Different things work for different people, different industries have different dynamics. Building a company is all about solving a problem. And as long as that's your priority, you're on the right track. And that's where I'm going to leave this video. If you enjoyed this video and want to see more content just like this, please give this video a like and subscribe to my channel. Alright, that's all for this one. Thanks for watching, and I'll see you in the next one.